Hey guys, I've been seeing a lot of buy to let compared to REITs videos, so I thought I'd chuck my 2 cents in. So I've drawn up a example sort of buy to let purchase over 25 years. So I've started with £100,000 house, putting in a £20,000 deposit. Seems sort of fairly reasonable with the current times. So that gives you a £379 repayment mortgage. I've done it on repayment mortgage, so you end up owning the house after 25 years, and so that stays constant for 25 years, assuming the interest rate stays the same. That's at about 3% interest. So again, maybe a bit hopeful that that would stay the same for 25 years. And I've shown the house appreciating 4% a year, which is a little bit over the national average, sort of over the longer terms, more like sort of 3.5%. But thought we'll be kind to buy to lets. And the sort of average recommendation is to allow about 1% of the property value for maintenance. So I've put that in here. You may think that's a bit high, I don't know, but that was sort of the rough recommendation. And then showing, just sort of looking at prices around sort of where I live in the slightly cheaper areas. £100,000 house seem to be able to get about £525 a month rent. So put that in and shown a 2% annual rent increase. Again, seems to be the sort of national average. So that runs for 25 years, and you end up sort of getting £10,000 a year at the end, as opposed to sort of 6.3 at the beginning. And tax, not 100% sure on. Sort of taking this as the sort of knocking the maintenance off the rent and knocking some mortgage interest off the rent, and then sort of tax at 20%. I think it could possibly be higher than this, but that's sort of a conservative estimate. And then so your difference here is sort of the rent minus the maintenance and everything, and minus the tax. So after 25 years, you would obviously own the house. So you've got a £256,000 house, and I've even shown investing the difference between the rent and the tax and everything. So after a while, you start ending up with a surplus after you've paid all your costs. And I've shown that being invested in, you could invest in REITs or in the stock market, say, and I've shown that at a 10% return. So you end up with about £50,000 cash, or £50,000 invested. So gives you a total of £306,000. And over on the right hand side, I've shown if you were to just take your £20,000 initial deposit and just invest it in a number of different REIT options, so real estate investment trusts. So you've got Digital Realty Trust, Realty Income, Primary Healthcare, it's a sort of healthcare REIT in the UK, American Tower, the cell phone towers one, Segro, sort of a alternative to Tritax Big Box, because they've been around a bit longer, and Simon Property Group, one of the sort of US, sort of slightly different to all the rest. And so at the bottom here, this gives you their sort of average annual return. So digital realty. So this is 25 years of the £20,000 invested at these sort of average returns, including the dividend or distributions. So digital realty gives about 15% annual return. Could be a bit high over the past, but that's what it has given. It's not to say it'll do in the future, but we'll see. So realty income gives you, from the looks of it, about 12% over the years. Primary health, a little bit over that, 12.8%. American Tower is about 14%. And then Segro hasn't done quite as well. It's about 5.6%. And Simon Property Group, just under 10, about 9.6%. So there's some bad ones in there, some good ones. But see, as a suggestion, you could split your £20,000 up, say, between the 6 of these and be sort of diversified. Obviously, you've got, a bit of commercial, a bit of sort of different types of industrial, healthcare. So it's quite a diversified set. And the average return, if you split it sort of evenly amongst these 6, would be £368,000. Obviously, you could have these in an ISA, have your £20,000 starting in an ISA, and you wouldn't have to worry about tax or anything. So you would end up with the £368,000 in total, and that is sort of sat on your backside playing Xbox or whatever you like. Where obviously the 25 years of having a buy-to-let, even if you have a management company sort of doing all the hard work, there's still a bit of heartache. They suddenly ring you up and tell you the boiler's broken up and there's a cost for it. They organise things, but you still have costs. So yeah, just an interesting sort of comparison, really. As I say, I've tried to be sort of favourable to the buy-to-let side, and it still just doesn't come out that well. I mean, some of these sort of outlier REITs here, like Digital Realty, has done really well. I mean, even if you drop that down to, say, 12% over sort of the next years, you still come down to, well, it's about the same. It's obviously the same as realty income. You're still getting 315,000. You're still beating the buy-to-let. And I think you've got to accept, even if the REITs were a little bit lower, you've just got that sort of peace of mind, ease of investing. You've got liquidity. You can sell, £100 of this anytime you like, where you can't with the buy-to-let. So interesting comparison, I thought. Leave your thoughts in the comments below if I've made any glaring errors, especially on the buy-to-let side or the REIT side, really. And drop a like if you thought this was interesting, and subscribe if you want to see more.